Day 13 of the Iran war, and both President Trump and Iran's new supreme leader are digging in. The Strait of Hormuz stays effectively shut, and IEA warns of a record production hit, and Brent is back above $100. Ahead on the show, we will be speaking with Singapore's Minister of State for Trade and Industry, National Development on how to cope and navigate these tough situations. Live from Singapore, this is Insight with Haslinda Amin. And also on the show, Morgan Stanley's chief fixed income strategist joins us on what an oil shock does to yields, credit spreads, and the Fed's rate path from here. Franklin Templeton's chief market strategist will give us his take on positioning for volatility, whether this changes the equity playbook and where safe returns are now. Meanwhile, higher energy costs are posing a risk to India's economic outlook as inflation quickened in February under the revised CPI series. The National Restaurants Association of India's Vice President, Zorawar Kalra, will be joining us on the cooking gas crunch and whether business closures will spread if supply remains tight. President Trump and Iran's new supreme leader have both struck defiant tones as the conflict in the Middle East drags on. In his first public comment since succeeding his father, Mujtaba Khamenei says Tehran will seek to ensure the Strait of Hormuz remains effectively closed. The blockade of the crucial waterway has delivered the biggest hit to global production on record. But Trump insists that stopping Tehran from obtaining nuclear weapons matters more than the cost of oil.
The situation with Iran is moving along very rapidly. It's doing very well. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it. They really are a nation of terror and hate, and they're paying a big price right now.
The war is causing government bonds and stocks to move in the same direction as investors fear high oil prices will boost inflation. Our senior Asia equities reporter, Abhishek Vishnoi, joins us now. Abhi, we talk about finding, some place to hide. 60-40 portfolio. How does that look like? Is that under pressure now with the chances of stagflation?
That's right. It stopped working again. It wasn't working when, there were rate hikes happening in the last cycle. It's not working right now. And the reason is pretty similar. Like I said, oil is actually going to weigh on growth, and it's also raising inflation. So these worries are weighing on both asset classes. There are fears of stagflation, and, there is some evidence to that. 2008, 2022, you saw fears of this kind of environment, but the real stagflation happened, I think, during the 1970s with, the Arab oil episode, and then there was the Iranian Revolution. So there are definitely worries, and you've seen liquidation. Largely all kind of assets and regions were falling in tandem, barring a few, like, US dollar and a few other, which were acting like havens. So, this has legs of, of further liquidation happening. I was looking at the drawdown that MSCI World has seen, so far. It's the biggest since 2022 when the Ukraine war started. It hasn't even gone to the level of 2008 and before that. So we are looking at a scenario where third week of war is about to begin. Defiant tones from Trump and the new Iranian leader. So the setup is not looking that great. More money would be looking for defensives or, esoteric strategies as well to hedge themselves and possibly exiting all kind of risk assets.
So these hedging strategies, are we seeing fund managers, adapting to the current environment of higher oil? In excess of $100.
That's right. We talked to a lot of fund managers, went through a lot of things that have come in our reporting, and there are a whole gamut of strategies that are being adopted. The obvious ones is obviously, raising US dollar cash. You are seeing a bid for US dollar. Most of the oil is traded in US dollar, so petrodollar effect is helping the US dollar. On the margin, surprisingly, China is also resilient, even when it's the world's biggest oil importer. I think the strategy of having diversified energy sources has helped, and there is this AI related trades which are creating most of the market cap. That's also supporting the sentiment a bit. So those are two things. Pictet is actually cutting equities, adding a bit of put options on both stocks and bonds. There are Goldman's buy side and sell side which are recommending option overlays to protect against meaningful downside, credit hedges as well. Gamma Asset is raising cash again, adding more to equity futures to hedge their exposure. And we also talked to a bunch of other long-only managers which are largely going defensive, raising cash, looking for more inward and cheap stories. So there are a whole gamut of things that people are trying to do to manage the risk.
What's the view on China? You did talk about China slightly earlier. I'm just wondering whether China could be an outlier, given that when it comes to the buffers, oil buffers, it has enough for a very long time.
I think so. It all starts with valuation. And China wasn't expensive when this war happened. And there's a difference between old China and new China. There is whole gamut of technological innovation that's happening. And even the laggards like Tencent have started now participating and retracing some of their underperformance on back of new agentic AI developments, etc. So that's one part of the story. The bets are going into these new China kind of thing. And then the global growth or global exports dominance of China, that's also getting a leg up. Obviously higher oil prices would largely keep all these green energy stocks like cattle and EV makers and other industries where China is dominating pretty nicely bid. So that's also looking very good. And then yes, oil buffers are there. I think there are a couple of buy side notes talking about 6 months kind of oil buffers which China can manage. So put it all together, it has been resilient and doing very well.
Abhishek, hang around for our next conversation. Let's get more perspective. Vishy Tirupattur, Chief Fixed Income Strategist at Morgan Stanley. Vishy, good to have you with us. We heard from Abhishek just slightly earlier. Everything is getting sold off, stocks, bonds in tandem. What's your reading on the market psyche right now?
I think the markets are genuinely concerned about in a significant level of higher uncertainty that pervades the markets today. And I think when you think from an interest rate treasury market perspective, you're caught with is the effect of all of this going to significantly challenge the labor markets, in which case perhaps we would see labor market weakness translating into Fed's rate cuts. On the other hand, if we see sustained pressures on oil prices that translates into higher inflation, that could potentially delay the easing cycle from the Fed later than what is expected today, even if the Fed looks through the shift. So I think the market is caught between these two very opposing views and unable to quite resolve at this point. So for now, we are staying neutral on duration because there is so much uncertainty.
I told him to take a cab, he didn't want.
And that uncertainty is driving volatility. When you take a look at vol in treasuries, the MOVE index at the highest level since November, how much room is there for further volatility, especially for the short end?
The volatility, there is still room for higher volatility because there is the range of uncertainty that we have just encountered. We've seen oil prices grow, within just a matter of 10 days. We've gone from, in the $70s dollar price to over $100 price. And given this and the range of uncertainties that we are confronted by, I think the volatility is going to remain elevated for a considerable period of time ahead.
And Vishy, when you take a look at two-year yields surging, we're looking at 375. I'm just wondering whether this is an indication of how, investors are skeptical that we will even get that one rate cut this year.
There is that the market skepticism is basically market has pushed out the timing of the rate cuts. But if you looked at the behavior of the treasury yields in the last, in the recent past, the market has been much more sensitive to labor market weakness, than, potential for higher inflation. We haven't really not seen that much of labor market weakness translate. So if as we get more data, and if this translates into substantial labor market weakness, we might expect a different, a different set of outcomes. But at the moment, the market is pricing in the likelihood that the easing from the Fed is going to be more delayed than what was there just a few weeks ago.
Hi, Vishy. Abhishek here. I wanted to ask what market signal would make you more constructive on bonds from here on, and what level of yields will you start adding duration more aggressively from here?
I think I will be looking for the signs from the labor market. The signs from the labor market. This data, whether the translation of what we are seeing in the oil market translating into real economic data and into the labor markets, that process will take time, and we'd like to see that effects. So we are watching all the labor data, employment data, both weekly data, and perhaps we'll rely more on the month-ahead data. Unfortunately, we just had data, so that data that captures that we've just had last Friday non-farm payrolls really don't capture what's going on in the market today. So this is a clear shock to the system, and we need greater clarity on the labor market situation.
Vishy, what assumptions are you making about inflation? We know that, there's a lack of clarity when it comes to the duration of this war. But what's pretty clear right now is that it'll take a very long time for disruption in the oil supply to get back to normal, even if the war ends today. That would feed into inflation. Has your inflation expectations changed from here?
In inflation expectations, we are in the process of revising our inflation expectation. The way we look at it is a sustained period of 10% higher oil price from where we were. We have gone past that. A 10% oil price increase translates into about 30 basis point push to headline inflation. And we keep in mind that this really affects headline inflation and very little effect on core inflation. But I think in this policy environment and in this current market environment, headline inflation will probably matter. In the market, I think we are not going to be solely focused on core. The headline inflation will matter, and the numbers that we're looking at are, that's the kind of elasticity. That's kind of metric we are looking at is 30 basis points push to headline inflation for a 10% oil price increase. And the longer it sustains, the worse it's going to be.
So having said that, what's the path of least resistance for 2s, 5s, 10s, 30s? How do you play treasuries right now?
I mean, to be honest, our recommendation for duration today is to be neutral with treasuries, and perhaps the level of uncertainty is too great for us to go out on the limb to make a specific duration recommendation at this point.
And Vishy, of course, the other issue that the markets are pretty preoccupied with is the private credit space. I mean, back in trouble. What's your take on it?
So I think that there is a lot in the private credit space one should think about. If you, in some ways, the challenges of private credit have been for some time. If you even look well past last year, you look at the BDC yields or returns to the private credit, they have been declining somewhat as a consequence of as the Fed started cutting rates. The potential for dividends in the BDC stocks has been coming down. The level of credit spreads have been narrow and coming down, and the spreads between the risk premium between the public and the private credit markets has also been narrowing. So the return potential for private credit has been coming down. But what's new here is really the shock the potential for disruption from AI in the software sector. Clearly, thinking of BDCs as the public face of private credit, the exposure to software sector is pretty meaningful. And if you dig further deep into it, we think that the typical exposure is the BDC exposure to software sector is about 26%. That's the level of exposure we see. And we dig further deep. a vast majority of the software exposures are from sponsor names. They were originated 2021 originations. They are more like a B minus or below type of credit, equivalent credit quality. And a coverage, from a leverage perspective, more like 7x times kind of leverage. So all of that, basically, the existing default rates in the software sector are very low. But I think the market is now confronted with how much of disruption is going to be there in these sectors, in this particular sector, which companies are going to be disrupted. And I would take the view that I'll take the view, which is a bit different from the market. The market view is all disruption is negative, and that is going to be challenging for all companies. I would take a slightly more nuanced view that it will take time for these relatively small companies with very little public information about them available. It will take a while for the market to figure out the companies that would be displaced by AI and companies that could potentially benefit from AI. Figuring that detail out will take time. Meanwhile, there are all these challenges of refinancing ahead. And that's the real crunch is going to be dealing with the refinancing of the wall of maturities that's going to hit in 27 and 28.
Vishy, what is the most mispriced trade in the gamut of things you cover at this point in time, and why is that? And what are you planning in terms of actions on that asset?
I think there is a range of mispricing in I would say some of the debt of staying within the context of private credit, the debt of the unsecured debt of the BDCs, I think still needs to adjust to a higher level of wider level of spreads, given all the focus and the higher elevated exposure of the private credit space to software and the potential for disruption and the time it will take to figure that out. All of this to me translates into the liability spreads. The unsecured debt of BDCs would need to adjust to a somewhat wider level.
Vishy, hang tight. Vishy Tirupattur of Morgan Stanley is sticking around. And of course, we had Abhishek Vishnoi, Senior Asia Equities Reporter, joining us for this conversation as well. When we come back, we'll get his insights on the tech sector and why he thinks it will take time for the AI disruption to play out in credit. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The conflict in the Middle East is seen threatening supplies of key materials used in chip manufacturing. One of them is helium, and Qatar accounts for more than 1/3 of its production. Bloomberg Intelligence says Asian chip makers have about 3 months until a deficit of this gas begins to bite. A prolonged conflict could impact the demand for the components that have been central to the AI boom. Vishy Tirupattur, Chief Fixed Income Strategist at Morgan Stanley, is still with us. And Vishy, prior to the break, we talked about those credit spreads. I'm just wondering whether the credit spreads that you were talking about, reflects the potential that the AI investment may not materialize or may just disappoint.
I think you should think about credit spreads in a bit of a nuanced manner. I think here AI presents two sides of the same coin when you think about credit. So on the one hand, we expect the AI and the AI-related infrastructure is going to require a massive CapEx cycle that's still ahead of us. And this CapEx needs to be funded, and we expect this CapEx financing to happen, to come through predominantly through the credit channels. So we estimate between 2025 and 2028, there's something like $3 trillion of CapEx needs to happen to simply finance the data center-related infrastructure. We have revised our expectations of the amount of CapEx that will happen in 2026. When we came into the year, we thought the major hyperscalers would end up spending $570 billion for CapEx in this year, in 2026. We have now revised that number up after the fourth quarter earnings. We think now that number is closer to $750 billion to be spent in this year alone. and 900 plus billion in 2027. So a lot of this financing will need to come from the investment grade market, the higher quality supply. So the market has to confront deal with a massive amount of supply, $1 trillion of net issuance in the US investment grade market this year. That's 60% higher than the year before. So that means without any concerns about credit, we expect the markets to widen, the investment grade spreads to widen, something in the 15 basis points range, simply because of the challenge of absorbing this issuance. When you think about the disruption, it's a very different issue.
But Vishy, so in the same breath then, if we see an AI capex downturn, investment grade will be most exposed. Is that the way to look at it?
Let's imagine that the capex doesn't turn out, which is not what our base case is. If capex turns out to be much less, then the amount of supply that the market will have to absorb will be lower. And that is actually not going to be that may actually be supportive of investment grade spreads. But the more interesting term to me is, just as we're talking about AI and the capex and the supply ahead, then on the other side of it is, if AI turns out to be very impactful, that could potentially lead to disruption. That disruption shows up not so much in the investment grade space. It shows up in the leveraged finance space. It shows up in broadly syndicated loans, and it shows up in private credit.
There's so much at stake here in terms of ROI from the capex that the hyperscalers are mobilizing. I'm just wondering, what's the biggest consensus assumption that could go wrong, in your opinion?
I think the challenges of AI infrastructure build, the data center build, is, power is a major constraint. That if we are off in our estimation of, an estimate of capex, one thing would be power could be a constraint. If we don't have enough power mobilized, and some of the challenges that we are now seeing from the conflict in the Middle East could contribute to some of those power bottlenecks. And you add to that, labor constraints. So some of these constraints, not so much the fundamental factors, the demand for compute vastly exceeds the supply of compute. That means in order to translate, to realize the transformative potential of AI, before that happens, you really need a massive amount of AI-related infrastructure to be put in place. Data centers are a necessary condition before you can see translating the potential into reality.
Vishy, thank you. Vishy Tirupattur, Chief Fixed Income Strategist at Morgan Stanley. Coming up, our exclusive interview with Singapore's Minister of State for Trade and Industry, Alvin Tan, on how the country is navigating volatile market conditions and how it could impact the Lion City. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. ASEAN foreign ministers are set to convene a special meeting on the Middle East conflict. A Philippine trade official says discussions will take place alongside the ASEAN economic ministers meeting in Manila. Officials are weighing the fallout from surging oil prices and disruptions to shipping and trade flows across the region. Leaders of the regional bloc had previously urged restraint to avoid actions that could further escalate tensions. Let's get exclusive insights from Singapore's Minister of State for Trade and Industry, Alvin Alvin Tan. Minister, good to have you with us.
Good to have you.
Singapore is exposed when it comes to developments in the Middle East, Iran in particular, in the sense that 60% of its crude comes from the Middle East, 16% of LNG comes from the region. How are we assessing the exposure to developments in Iran right now?
Haslinda, we are concerned about the issues in Iran and the broader regional conflict. In fact, half of our piped natural gas comes from the region, and we also have been diversifying our liquefied natural gas LNG sources over the years. So we now have sources from, for example, Australia and the US. So it puts us in quite a good position. But of course, we are still worried about this. In addition to that, we also have fuel stockpiles, and it is also interchangeable between both diesel as well as gas. And for our power companies, if they require the use of these stockpiles, we're ready to release them. So we are in a position where it is concerning, but we have measures in place to mitigate some of these measures.
There are buffers, and we had the government say that it could last for months. But we know there's a lack of clarity when it comes to this duration of this Iran war. Some say perhaps it could go on as long as 6 months. I mean, where does Singapore stand on that? You talk about mitigating factors, measures. What other measures can be adopted? Yes,
I think one critical part is on ensuring energy security. And what we've done, we've put in place for many years already before. So the measures that I mentioned about fuel stockpiles, diversifying our oil, our liquefied natural gas sources, those have been put in place for a long time. In addition to that, we are also diversifying the sources of energy, including in emerging technologies like nuclear, as well as PV and solar, and also linking up to the ASEAN power grid, importing of energy sources from within the region.
Needless to say, cost is an issue. Inevitably, if this goes on for quite some time, consumers will have to pay a higher price for their energy. What is Singapore thinking about that? Is that inevitable? What are we looking at? What kind of rate increases might happen?
Yeah, well, Singapore is an open economy, and so we import a vast majority of our energy, and energy is an existential issue for Singapore. And that's why we need to make sure that we have short-term measures in place, and also long-term measures. In the budget, we also announced rebates, use-safe electricity rebates for our households, so that will come into play. And we're monitoring the situation in the Middle East very carefully, and we will step in to support households and businesses if necessary.
So those increases in energy rates
These are rebates. Yeah, so rebates, we need to anticipate higher energy rates, and all can play a part. With government coming in to provide rebates, as we mentioned in the budget, as well as consumers ourselves, and for businesses to also taper and to manage their energy use more efficiently.
Singapore's always been seen as a safe haven. I'm just wondering, in terms of capital flows, have you seen capital flowing from the Middle East, Dubai in particular, as a result of this Iran war?
Well, the capital flows as well as assets, fixed asset investments into Singapore has been growing. So, for example, last year, 2025, we recorded commitments of about 14.2 billion. That's about 5.3%.
But have you seen an acceleration as a result of the Iran war?
I think it's still too early to tell. But if you look at the overall trends, we're seeing more of these investments coming into Singapore, and we see a healthy increase. And that's primarily investments into manufacturing, for example, and it's creating about $18 billion worth of value add. So the key part, Haslinda, is to make sure that Singapore remains open, connected, as well as stable, so that investments can come.
But reports have suggested that wealth is actually transferring from the Middle East to Singapore, in particular from Dubai to Singapore. Are we seeing that? Are perhaps Asian entrepreneurs, the Asian wealthy people who have parked their money in the Middle East, are now having second thoughts and now gravitating that to our shores?
Well, all the different financial hubs and financial center, of which Singapore is one, play very differentiated roles within the global capital flows. Hong Kong is one, they look after the Chinese market primarily, Dubai, Middle East, Africa, Europe, and Singapore play our own part in this part of the world. So I think the financial hubs are complementary, We are doing our part to make ourselves attractive to businesses, to capital flows, and we put in many different measures in this regard.
So in terms of these capital flows that is anticipated, which has been observed actually by a lot of the analysts, I'm just wondering whether we are ready, Singapore is ready to cope with those surge in capital flows in terms of regulations, scrutiny, and so on and so forth.
Yes, and we have put in place many of these measures over time to allow for the capital flows to come in, to also make sure that there is no increase in assets, overvalued in the Singapore market. So we put in place these in time. But what I also wanted to mention is that in the short term and the medium term, Singapore is in a good position. We're in a good position because we have the Economic Resilience Task Force, chaired by the Deputy Prime Minister, and we're looking at particular issues, turmoil, tariffs, and also technology. And part of that work is also looking at the longer term measures for us to refresh our economic strategy.
Speaking of technology, are you also seeing that flow, that interest to perhaps use Singapore as the base, as the hub for technology, given, the uncertainties elsewhere?
We're seeing that. We've been seeing that over the last couple of years. In the budget this year, AI was a key part of what the Prime Minister had mentioned, and the setting up the AI Council to make Singapore a hub for AI experimentation, research and development, and deployment in the commercial side. On our side, we want to make Singapore continue to be a hub for startups to find Singapore a very fertile ground from which to grow and to thrive, and to expand in the regional and global markets.
It's no secret that there was a lot of competition between Singapore and Dubai, for that matter, for this startup hub, tech, AI in particular. I'm just wondering whether you're seeing the flows coming back, whether you're seeing a lot of questions about how to base themselves here. Is there a trend happening?
Well, we see a healthy startup ecosystem. We have about 4,500 startups in Singapore, about 220 accelerators, and about 500 VCs based in Singapore. In fact, VC investments into startups over the last 10 years have quadrupled from about $1 billion to about over $4 billion. And we are ranked now fourth in Startup Blink's Global Startup Ecosystem Index. And that was up from the 16th about 5 years ago. So I think we're in quite a good position to be welcoming for startups.
So are you seeing an acceleration of that as a result of the Middle East situation or not?
Well, we play a differentiated role. Startups come in because they see that Singapore is a fertile ground, and government support has been also very forward-leaning. So we will do all that we can to be as attractive to startups, let them grow their businesses here and to expand across the region and the world.
Minister, what is Singapore's competitive edge when it comes to being a hub for AI?
Yes, well, I think a few. First, we have to continue to be a trusted hub where companies, where businesses, and where people know that there is strong regulatory certainty, strong political certainty, as well as the fact that you have access to capital, access to talent, access to markets, and also access to spaces for startups and businesses to grow. And that's what we've been doing with the Economic Strategy Review and the Committee on Entrepreneurship, which I co-chair with my colleague Dinesh Vasudas. And we are making sure that we can enhance that to make it more attractive for startups to base in Singapore, to grow in Singapore.
When it comes to being an AI hub, there's a lot of competition. Even Malaysia is trying to be an AI hub. I mean, that's why we're looking for that competitive advantage. And is there a risk Singapore could fall behind because of regulation?
Yeah. Well, as you know, Haslinda, we always are very responsive in terms of regulation. So it's part of the Economic Strategies Review. We are constantly in discussions with our startups, and many startups, of course, and actually, in fact, many businesses are now deploying AI in their processes. And the key part is being adept, being flexible, and working with businesses and working with the trade associations to ensure that the regulations are on par and flexible so that you can deploy startups, you can deploy AI effectively within your businesses. That's our cutting edge, and I think we continue to review that over time.
And what are the biggest concerns among AI startups in, being, I guess, headquartered in the Lion City?
Yes. I mentioned earlier on, I think, access to funding, and that's why we've made a couple of moves, including a $1.5 billion injection into the Anchor Fund 2, a $1 billion injection into the Startup Singapore Equity Fund. And we've also made moves within the MAS's Equity Markets Working Group, making sure that startups can access funding in the public markets and the private markets. In fact, for the EQDP, the Equity Market Development Program, we injected another $1.5 billion to enable our public equities market to grow. And I was just at NASDAQ's office opening on Tuesday. That is going to be very, very important and very useful because we are building a global listing board, linking SGX to NASDAQ as a dual listing bridge. But we also recognize that not all startups and companies want to pursue a public exit. So we've also set up a growth capital working group chaired by Minister Chee Hong Tat, and that will avail more growth capital for startups to tap on, and also to recycle that capital for new ventures.
Minister, I want to talk about trade. For lack of a better word, I'm going to say it is a spat between Singapore and the US in terms of the differences in opinion when it comes to the trade balance. You know, we talk about a 27 billion trade surplus versus a 27 billion trade deficit. Why is there such a huge gap?
Well, the US is a very important trading partner for Singapore. And Haslinda, you're mentioning about the Section 301 notice. In fact, you're right. We do have a trade deficit with the US, in fact, a $27 billion trade deficit.
But it alleges a surplus.
Yes, we have overnight responded to the USTR and to share with them what our figures are. In fact, the US Bureau for Economic Analysis data showed that, in fact, Singapore has a $27 billion trade deficit with the US. So we are responding to the US. We are also seeking clarifications on other aspects related to Section 301.
These are two really close trading partners, which go a very long time. I'm just wondering why that could have been a miscalculation or a misunderstanding. Where do we sit with that?
I think what's important, Haslinda, is we have open channels. And as soon as we received the 301 notice last night, we wasted no time to explain, to seek clarification. And in fact, as you rightly pointed out, we do have a free trade agreement with the United States. And we are bullish that our trade flows and our trade relationship with the United States will continue to grow over time.
Might that trade agreement be at risk because of what's happening right now? And might Singapore face a higher tariff rate on the back of that, you think? Are there concerns? Are that part of negotiations as we speak?
I doubt that the trading relationship between the US and Singapore will be affected. In fact, many US companies are here, and we have also, in our investments to the US, created hundreds of thousands of jobs in the US. As I mentioned earlier on, we have a trade deficit with the US. We have a strong trading relationship. Our officials speak to each other, and we're a phone call away. And where there are miscommunication, we are quick to be able to clarify or seek clarification.
If the US maintains its position, is there something else that Singapore can do? Might it seek to solve it internationally?
Yeah, I think the most important is where there are misinformation with regards to, for example, this trade surplus or deficit. We move quickly, clarify, and then also seek clarification, which is what we're doing right now.
So you are confident that it can be resolved soon?
We have already been in talks with them. And we are seeking clarification on their other queries as well.
Minister, talk to us about the impact of the tariffs on Singapore's economy and how trade stands at this point in time.
Yes, well, I think all countries are affected by the trade tariffs. There is a little bit of uncertainty with regards to the Supreme Court ruling and how that will percolate down. Singapore continues to remain resilient, and that's why we stand ready to support our businesses. But Haslinda, what's even more important is for us to look long-term. Singapore has always looked long-term, and that means enabling our economy to be resilient, refreshing it through the Economic Strategies Review. And so when crises occur, it could be a regional conflict in the Middle East, it could be an oil shock, or it could be tariffs. We remain resilient, we remain attractive to the flow of funds, capital, and talent.
But what's key to that resilience? Under current circumstances, given the current environment, is it about diversifying markets? Is it about diversifying trading partners? Are we now looking more towards the ASEAN neighbors as opposed to elsewhere. How are we thinking about, our trading arrangements?
Yes, just as we spoke about diversifying our sources for LNG, we are also diversifying our trade relationships. In addition to ASEAN and our major trading partners like the US and China, we have been traveling. I personally have been traveling to Africa and Latin America, negotiating trade agreements with the Latin American blocs like the Pacific Alliance, Alianza del Pacifico, and also Mercosur, and we landed these 2 trade agreements. My focus this year is also to widen that trading agreement and trade relationship with Africa, particularly in the East Africa, eventually SACU and ECOWAS. So we've expanded these trading relationships, diversified it, and to make Singapore more resilient, I think that is a key strategy for us.
We talk about how multilateralism is better than, bilateral arrangements. Is there concern that multilateralism will dissipate given the challenges that we're seeing right now, and given how countries are now doing business, between 2 countries as opposed to a group of nations?
Well, we are concerned because a well-functioning multilateral trading system is in our interest as a small, trade-dependent country where trade accounts for 3 times our GDP. And so we are involved with the WTO reform, and we see that overall trade has increased over time. It's just that trade is now increasing within blocks. And we continue to be involved with RCEP, CPTPP. I'm involved with many of these negotiations myself. But we think that having plurilateral arrangements like CPTPP, RCEP will help to strengthen the multilateral trading architecture. Even under cusp of the retreat to multilateralism, I think we need to play a role, and indeed we are playing that role.
So we're not really seeing trade fragmentation and impacting trade in the end for a trade-dependent nation like Singapore?
I think many of our trading partners within these blocks that I have mentioned earlier on, those are important. ASEAN, CPTPP, RCEP. These are some things that we are participating in, and we are strengthening even as there is WTO reform ongoing.
Minister, such a challenging time for the world right now. What is the biggest risk for a nation, a small nation like you said, such as Singapore?
I think the biggest risk, Haslinda, is we are not agile and we are complacent. And we certainly are not so. We have measures in place for short-term shocks, but more importantly, we have long-term plans to refresh our economic strategy. And I think that will put Singapore in good stead to be attractive to capital, flows and people.
Ministers, thank you so much for joining us today. Alvin Tan, Singapore's Minister of State for Trade and Industry as well as National Development. Still to come, India looks for ways to secure the safe passage of tankers through the Strait of Hormuz. Details coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. India's been trading for about 5 minutes now. Let's take a look at the initial numbers. We're seeing pretty much Asia under pressure on the back of that spike in oil prices. We have Brent at about $100 a barrel, and that's weighing on the Indian benchmarks right now. The Sensex down about 1%, along with the Nifty benchmark currently down about 1.2%. India's rupee also falling to a new record low on the back of surging oil prices. Of course, this is one currency that's been testing lows, looking for a floor, but not finding it somewhat. 92.37 is the level that we are looking at. Now, Bloomberg has learned that India is in talks with Iran to secure the safe passage of some tankers through the Strait of Hormuz. Let's get more. Bring in Bloomberg India aviation and infrastructure reporter Meher Mishra. Meher, how many India-bound vessels are stuck in the Persian Gulf right now?
Hi, good morning, Haslinda. So there are about 21 ships that are stuck in the Persian Gulf. These 21 ships are bound for Indian shores and have crude and LPG on them, which is crucial for India's energy needs. There are also 2 more ships which are Indian flagged ships but not bound for India. So India essentially is trying to kind of negotiate a safe passage for not just these 21 ships that are bound for India, but also the other 2 which are Indian flagged ships. Now, we have seen that a couple of ships have, one of the ship landed at an Indian port yesterday, and the other one is to land either today or tomorrow. So some of the ships have started to be cleared and have started to land on the Indian shores. Now that is where it is for now, and the fact also is that there is a sense that India may not be able to negotiate a safe passage for all ships in one go. They will have to be gradual depending on the situation of the war in that particular, or of the conflict in that particular region, and India will have to be very patient as far as negotiating these return of these ships are concerned.
So it is about India's strategy. What really is the strategy to get these vessels back?
Yeah, so essentially it all started with India's External Affairs Minister speaking to Iranian leadership a couple of days ago, which is when a couple of calls were made, and a request essentially was made during that call to ensure that some ships are allowed to pass the Strait of Hormuz, since that is a crucial link to ensure India's energy needs. With that strategy, they started talking to each other. Then the levels were escalated. The Prime Minister Modi also spoke to Iranian President yesterday. So things seem to be moving in a direction where Iranian leadership is also willing to discuss it with India and negotiate the safe return of these ships.
Meher, will the return of these ships ease India's energy concerns?
Yes. So essentially, India is world's third largest importer of crude, and a large part, about half of its energy needs, are met through Middle East. Of the total energy needs, about 40% pass through the Strait of Hormuz. So Middle East and the Strait of Hormuz is very crucial to fulfill India's energy needs. Now, essentially, with these 2 ships coming, refiners have got some sort of a crude to be able to refine. As far as India's consumption is concerned, crude or fuel so much is not a problem so much, but gas continues to be a problem, to be a concern, not yet a problem.
Right.
But once these 21 ships are allowed into India, this will help resolve the solution in the interim.
Mehul Mishra, Bloomberg India Aviation and Infrastructure reporter. Thank you. Still ahead, Franklin Templeton's Stephen Dover will be joining us to discuss how to navigate volatile markets as the Middle East crisis continues. And as the gas crunch bites, the VP of the National Restaurant Association of India will be joining us to discuss the impact on its members. More to come in the next hour of Insight. This is Bloomberg. Welcome back. You're watching Inside. Asian stocks are under pressure this Friday, tracking losses from their U.S. peers. Meanwhile, oil prices are also still in focus amid growing fears that the war in Iran will further crimp energy supplies and boost inflation. Let's do a check-in with Avril Hong on where the markets are. And Avril, we know that just a week ago, no one could imagine $100 oil.
Yeah, here we are. And this is a week where Brent has probably seen one of its most volatile trading ever. Not just about breaching 120 earlier in the week, right? Because if you look at some of these trend lines, this line in yellow shows you the 200-day moving average. About a week ago, we actually breached that. And since then, we've rallied 50%. If you look towards the right side of this chart, you'll see as well the candle showing you that firming uptrend, which suggests that this is not just about a squeeze. This is repricing that's underway in energy markets. Flip the board. Let's take a look at some of these Asia stocks as well, because the tech outlook is looking a bit more tepid if you think about the inflation trajectory, what this means for rates, but there's a fresh concern as well in the form of helium. Now, this is a gas, of course, that is absolutely critical for chip making. There's really no substitute, and this is used to cool wafers in the production process, and a third of the global supply comes through Qatar. So that is a fresh concern as well for markets as this drags on, and with everything, it's really the duration of the conflict that has been on investors' minds. For now, the big three in Asia say, they're not signaling any disruption to supplies, but we have the likes of Bloomberg Intelligence saying maybe a tail risk in about 3 months for now. Has?
Errol Hong, thank you. Let's get perspective. Stephen Dover, Chief Market Strategist at Franklin Templeton, with assets under management of about $1.7 trillion as of the end of February. Stephen, good to have you with us. Oil hovering at about $100 a barrel. When you take a look at the stocks market, are they adequately pricing in risk?
Stock markets are pricing in a short-term risk, and I'll tell you a couple indications of that. We look at oil prices, which have backwardation, which basically means that $100 price per barrel, which was just mentioned, is in the short term, but long-term prices haven't delivered that much. So there is still the market expectation that this war or this conflict will be resolved in a shorter period of time. What we think is that it's very hard to tell, but obviously there's some very significant tail risk in all sorts of ways. I hadn't heard about the helium issue before that the reporter just mentioned, but it's much broader than oil, of course. It's natural gas and fertilizer, and it's cargo that goes through that strait. So it's all very important and will lead to higher inflation.
How are you assessing the possibility of stagflation?
Well, that's a very good point and a very bad word that we haven't talked about for a while. Our analysts think that a 10% increase in the oil prices increases inflation in the United States by about 25 basis points, and oil prices are up 30% at 90. If that averages, but you just said 100, so that's even more. So that means that inflation could come up to the United States to about 3.75%. Definitely not good. What that means, as already indicated, is that interest rates are now highly unlikely to be dropped this year, and it drops the growth rate. So that's stagflation. I don't think it's the stagflation of the 1970s where we had inflation rates above 10% and at its peak interest rates above 16%. So we don't have anything like that. But it's a very different interview I'm doing with you at this moment than I would have done just 4 or 5 weeks ago when our outlook was much more positive.
There's still so much uncertainty out there, including the duration of this war. In terms of the possible mispricings in sectors, where might they be?
Well, you have all of the extreme sectors. Obviously, everybody jumps to oil sectors. They jump to countries that are most impacted by oil. So I think that some of those situations might be overly negative, potentially, if this ends shorter, or we hope it ends quickly. On the other hand, some of the areas that have done well, the defense industry and other industries, might have moved too far. So we look at a market. Maybe the way that I can frame this is Templeton, particularly Sir John Templeton, always thought that big conflicts, big movements in the market were opportunities to buy. Indeed, all the research indicates that when you have a correction, it is an opportunity to buy. But there's a couple problems with that. First of all, that's true looking backwards. You never know looking forward. It's more known now, so to some degree that's priced in. But I think most importantly, this market is not yet pricing in a major shock or a major event. The market still thinks this will all be over fairly quickly, and hopefully it will be. We don't know, but there is a significant tail risk now that has to be taken into account.
How will the market look like if it starts pricing in that huge risk and tail events, as you mentioned?
Well, I think that just to frame it, as we entered the year, there were so many positive tailwinds, positive issues that were pushing both the market in the United States and the global market. So our prediction for the year was to have an up market, mildly up, 5 or 10%, but up after a string of very strong years. Earnings have, and actually earnings still look good. Inflation looked like it was going to moderate. Interest rates looked like they were going to fall by at least maybe 50 basis points. In the United States, there's fairly significant fiscal support. There are very large tax refunds. The AI companies were doing massive capital spending. We thought the dollar would at least be stable, if not weakening. So we've been pounding the table to invest outside the United States, to invest in smaller cap stocks. Well, almost all of that is still true. It's very much mediated or slowed down or at a greater risk because of what's happening. And so it's just very difficult to be as positive as it was before. If reality is priced in, which we unfortunately don't know what reality is, but if that's priced in, I think the market would go down further. I think that it's quite possible we'll have a correction. We have that in some markets, but not most markets. Correction being a market down 10%. But certainly, if oil prices, or excuse me, if the strait is closed for a longer period of time isn't that long. We're talking 3-4 weeks. We could have dramatically higher oil prices. But remember, we start looking then at cross assets because of the gas, because of the fertilizer, because of remittances, because of cargo, because of helium. There's all sorts of things that start to affect the economy all over the place.
So in terms of how your portfolio should be looking at, 60-40 still intact or not? And some suggestion perhaps you should be looking at sitting on more cash right now.
I think most investors were already sitting on cash. So let me step it through different parts of the portfolio. First of all, on the fixed income side, we're in essence short duration, shorter length of period of time investing compared to whatever the benchmark is. And that's generally true, although we still think that in terms of cash, it probably makes sense to increase your duration a little bit to 1 or 2 years to get those better yields. So we think fixed income is likely to produce a return that is basically equal to the coupon. We were more positive about interest rate cuts at the beginning of the year than we are now. We don't think anymore that there are going to likely be interest rate cuts. In the equity market, we're still positive on the market. You can tell in my voice I'm hesitant on that because there is this tail risk. So we're not adding new money. We're looking for opportunities as companies are repriced. Where we'll look for opportunity is if there is a correction. I think one of the ways to look at the entire situation is look at the volatility in the market, to look at the VIX. And historically, when the VIX is above 30, the market's almost all the time been up. A year later, VIX is in the high 20s now. But certainly if the VIX gets really high, if it gets 35 or 40, I would take that as probably an opportunity to enter into the equity markets.
And in terms of safe havens, Stephen, I mean, at this point in time, it looks like only the USD is being seen as a safe haven play. When do you think the likes of gold, would play that role?
That's a good question, and probably most investors would have expected gold to actually appreciate in a situation like this, because certainly in the past, with geopolitical uncertainty, it has. I think gold probably hasn't appreciated, one, because it's had such a run-up already. I think that we have to remember that there's not a cash flow for gold, so the lower the interest rates, all things being considered, gold is worth more. So we've gone from a situation where we thought we were going to have a couple cuts to now not likely to have a couple cuts. So I think that's the problem with gold, and it'll adjust from there. It is interesting that after all of the talk last year about the dollar no longer being a safe haven or foreigners not investing in the US dollar, it still does seem to be somewhat of a safe haven at this point. But I would argue probably not as much as it has been in the past. So I think investors are confused right now and really not making moves, because we're living in such a situation of, I keep saying this, but this big tail that we just don't know the probability of that happening.
And of course, we've seen how stocks and bonds are moving in tandem. What do you make of that? And what do you make of the massive volatility we're seeing in terms of the bond market as well?
Well, the bond market doesn't know how to sort this out either. And it's that bad word that you said, stagflation, because clearly, if we have inflation, then interest rates at a minimum aren't going to be cut. They might rise. But oil is a tax. It's a shock, and it tends to reduce growth. And so, all things being equal, when you have lower growth, you would lower interest rates. So the Fed or all of the central banks around the world are going to have that terrible conundrum that there's an argument to raise rates, there's an argument to lower rates, and it's very difficult for them to figure out what the right course of action is.
You say that the bond market is confused. It doesn't know, what conclusions to come to when it comes to inflation. But considering that oil disruption will take a very long time to play out, inflation is likely to be, a rising concern. Is the bond market, in fact, underpricing inflation risk?
I don't think so. I think in times like this, at least based on my historical observation, the bond market is probably a little bit better at pricing in risk than the equity market because it has fewer variables that it's pricing in, meaning really just interest rates and prices, whereas equities are pricing in all sorts of different industries and companies and everything else. So I think as a historical equity investor, I always look at the bond market because I think it gives a pretty good indication of what the risk might be, or what the consensus risk might be. So let me give you another example. You can look at the bond market and you can look at spreads, which have increased a little bit, but not significantly. So once again, I'd start back where I started at the beginning, saying I don't think that the market is pricing in that tail risk as very likely, which hopefully is the case, but that risk is there.
Stephen, hang tight. Stephen Dover, Franklin Templeton is staying with us. When we come back, we'll get the insights on Indian markets as energy risks remain front and center for the import-dependent country. This is Bloomberg. Taking a look at Indian assets, they've been reeling from higher oil prices. The Nifty, in fact, among the worst performing major stock indexes this year. The Sensex currently extending its decline by about 1% right now. It's all pushing the rupee to a new record low as foreign investors stay defensive. In fact, foreign investors have sold about $5.5 billion worth this year on concerns about high oil prices. Adding to that concerns also the software industry, which may be impacted impacted by AI? Well, taking a look at the benchmarks, pretty much red across the board. The Nifty Bank Index currently down about 1.5%. Let's talk India and the market. Stephen Dover is back with us. Stephen, India, one of the laggards, and understandably so.
Yes, absolutely. So let's start with a framework. Coming into this year, we were arguing for foreign investors to invest outside the United States, or at least not increase their allocation in the United States. That looked like a good play until about 10 days ago. As part of that, we encouraged investment in the emerging markets. So where do we sit today? I'm going to get to India, but we sit today still thinking there are opportunities in the outside of the United States. A higher dollar, I would argue, for dollar-based investments makes those markets a little bit less expensive. So maybe longer term, there are some opportunities there. We think that Europe, we look at relative markets right now based on the conflict in Iran, and the United States actually just looks better positioned, certainly relative to Europe, relative to Japan, relative to many emerging markets. Although some emerging markets, like those that export oil, some in Latin America, are going to do better. But we come to India. And so India is well known as dependent on oil. Of course, India is probably less known, but also dependent on natural gas and fertilizer as well. So India, just in terms of the situation, I'm not saying anything all of your listeners don't know, is harder hit than other countries. What I am saying is that that's very well known by foreigners. And that's why you have, I think, a knee-jerk reaction of foreigners taking money outside of India. Last time I was on your program, I talked about the long-term aspects for India, where we're very structurally positive. You have to remember, our money tends to be long-term, a longer-term investment money. So we're not so much the hot money that comes in and out of India. And so we're looking for opportunity.
If you take a long-term view, why not get in? If you take a long-term view, why not get into India right now? Nifty below 24,000. It is a key psychological level, and there are opportunities to be had, no?
Yeah. I think so. I think that, remember, for us foreign investors, the rupee at an all-time low makes it cheaper on a relative basis as well. And so our fixed income analysts over the long term are more positive or constructive on the rupee, which is a little bit of a tailwind. So here's what I think, and I want to tie this into my first segment, and that is, we don't think that overall the market has panicked. And we don't think overall the market is pricing that tail risk. But that said, as you asked me what countries or what sectors or what areas aren't doing very well, India falls into that category. So if we were to look at a place where it's very likely that the risk or the downside, certainly for a long-term investor, might be over-exaggerated, that would be India. So I don't know that we're there yet, but we've got India down even as I'm talking on this program. So we're seeing a situation where some of the opportunities we wanted in India for a long time are less expensive, and so that's what we're seeing. And if the tail risk happens, India will likely fall even further, and that might create more opportunities for us.
What would trigger a turnaround in terms of foreign investor sentiment? India, it seems, has not been able to change that. Foreign money keeps flowing out.
Yes. So as the previous reporter said, it's perhaps something like India actually being able to get the tankers through the strait and receive oil. That's a tactical not correction, but upwards movement in the market. If that were to happen, if India somehow were to not be as impacted as other countries, I do think long term this is probably a positive for India, as I think its position diplomatically in the world is probably relatively improved, certainly compared to the United States. But I think that structurally, India is going to have to do what China's done, and that is move towards energy independence and move away from so much dependence on oil. That's a 10-year horizon that India needs to look at. But India certainly has the people and the innovation and the ability to do what China has done.
Not very long ago, we were talking about capital flowing either from China to India or India to China is almost like a zero-sum game. Is capital now flowing into China in a deliberate manner at the expense of India?
I don't know that China's flowing to either on a net basis, but on a relative basis, yes. I would think, at least from a tactical point of view, China looks better in this situation. I think the upcoming meeting between Xi and Trump, the hand of negotiating power has probably increased for Xi. And so it'll be a very interesting meeting to see what happens. As you know, what we would have been talking about if it wasn't this war would be the tariffs. Trump's ability to implement tariffs on most countries has been diminished significantly, still can have some tariffs on China. And I think China's just relative global standing has probably increased as well, having perhaps being a middle person or a negotiator in this situation. So I think for all those reasons,
what would you buy in China, Stephen?
Pardon?
What would you buy in China, especially on the back of the NPC meeting? Yeah.
Yeah, so we're still quite positive on two themes in China. One is China technology. I think I've mentioned before, I think there's some hubris in the West, particularly in the United States, that that is where all the primary AI is going to be. I think China very rightly is focusing its AI on increasing productivity as opposed to kind of general intelligence. And I think that could pay off very well for China. And then secondly, our never-ending theme that we think that there will be some positive opportunity for the Chinese consumer, so consumer sector.
Stephen Dover, Franklin Templeton, thank you so much for your time today. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're tracking shares of Indian food delivery companies, which have come under pressure in recent days amid concerns that order growth could slow. This follows reports that restaurants are trimming menus due to a shortage of cooking gas in the country, which is a disruption linked to the ongoing conflict in the Middle East. Taking a look at where we are in terms of Swiggy, currently in positive territory. Eternal, though, in the opposite direction, down about 1.6%. Now, for more on how India is being impacted by war-related gas shortages, let's bring in Bloomberg senior editor Manaka Doshi. And Manaka, we know that 60% of LNG comes from the Middle East, and most of which actually goes through the Strait of Hormuz.
That's right. This war and the disruptions that it's led to in terms of the energy supply chain is hurting India significantly. Haslinda, this is a classic story of rising demand, import reliance, as you pointed out, and insufficient reserves. Gas is, as of now, still a very small segment of India's primary energy requirements, about 6% or so. But it's been growing on the back of schemes promoted by Prime Minister Modi's government to ensure a shift to a cleaner fuel, and move households away from wood and kerosene and coal-fired stoves to, LPG cylinders, as they're called here, which is liquefied petroleum gas. Now, we've seen demand rise significantly. As you pointed out, much of this demand is being met through imports specifically from the Middle East, which has been disrupted at this point in time. We don't have reserves for gas. We do have small reserves for crude oil. We've been able to diversify that sourcing base. Gas has been a bit of a challenge for us, and this crisis in the Middle East has therefore caught the Indian government somewhat unprepared, if I might say so, because we've been struggling to make sure that there's enough gas for everyone's requirements, as a result of which we've seen cuts first to commercial establishments as the Modi government prioritizes households and, to make sure there's enough cooking gas for homes. So commercial establishments of a variety have been impacted, from fertilizers to tile manufacturers and to restaurants, which have become the face of this crisis because, they are what everyday people use and they are such a large employer. And there are reports coming in from across the country on how large restaurants, small eateries, they're all struggling to cope with this.
Menaka, stick around. And speaking of restaurants, let's get perspective from Zorawar Kalra, founder and MD at Massive Restaurants and Vice President at National Restaurant Association of India. Thank you for joining us, Zorawar. First of all, give us a sense of how badly the restaurant industry has been impacted. We know that, restaurants have removed rotis, puris from the menu already.
Yeah, thanks for having me. As Menaka said, we rely mostly on imports, and the imports are almost completely stopped, although some good news is creeping in. But before that, let me address the size and the importance of the industry. As Menaka said, we're the second largest employer of humans in India after agriculture. So that's about 8 million people directly employed and another 8 million through ancillary industries. We're also a contributor to the GDP in a major way. I mean, this is the fourth largest economy in the world, and we contribute between 2 and 3% to the country's GDP. So it's an important industry. And the fact is that it's about a 6.6 lakh crore ecosystem. That's about 71 billion a year. And 75% of this relies on LPG. 25% relies on CNG, piped gas, that is, or electric. But 75% of all the restaurants and hotels in the country rely purely on LPG as the primary form of cooking. So it is obviously, it can become a huge crisis if not addressed immediately. At this point in time, we're seeing shortages across the country in tier 1 and tier 2 cities. Many restaurants and hotels are facing it difficult to to survive the weekend, and many are already shut. Many have also already moved to much smaller menus that rely on non-LPG based cooking solutions. That being said, we've also been receiving some good news. And this news is fresh, right? This is a fluid situation. Things are changing by the hour, by the minute. Yesterday, the Union Minister for Petroleum and Gas, Mr. Hardeep Puri, had said that the commercial supply of LPG will start again. It's not started yet, but it appears that that's in the works. And the second thing also we've been hearing is that a big cargo ship carrying about 1.35 lakh cubic tons of gas have reached the Mumbai ports. Another one is on the way. So there is some silver lining that we're seeing. But at this point in time, if you take a snapshot in time as of this morning, there is a major challenge being faced by a majority of the institutions that serve food. And remember, this is a country that, our industry feeds the nation, right, in a way. So this is a challenge that hopefully will be contained. We're hopeful seeing the action being taken over the past 24 hours. At this point in time, it remains a challenge.
Zorawar, give us a sense of how much of the industry will be impacted. How might this play out? The smaller players, for instance, will find it hard to survive.
Absolutely. And that's the real painful thing, right? The larger companies still may be able to hold some kind of inventory in banks, although that's also dwindling. The smaller one does not have a robust or sophisticated vendor management system or ability to hold inventory costs. So the smaller one is the one, unfortunately, that ends up taking the brunt of it. And that's being taken into cognizance by the government and the authorities. And as a result also of the efforts that the NRAI has done, which is the body that I represent, which is the largest representation of restaurants within the country. We've been proactive. We've been reaching out to the powers that be. We've been going on media outlets such as yours to spread the word that this is actually an impending crisis. This could be, if not addressed immediately, an existential crisis. So keeping all of that in mind, Unfortunately, the smaller one will be affected the most. But look at the ecosystem. If the delivery kitchens stop, the entire gig economy also gets affected. So there is a lot at stake here. There's no doubt, and that's why the government is taking extreme steps and is acting fast. The pace of work and the pace of action is actually very, very quick. We just hope that the results start coming out faster, the LPG starts flowing in, and obviously as a overarching thing to above all of that, we hope the war stops.
Zorawar, if I can just jump in with a few operational questions here. Do restaurants, broadly speaking, across the country have access to any LPG at this point in time? I know that, the minister said what he said yesterday about making some allocations, commercial LPG allocations available to the industry. When is that going to start? Any details available?
So we at the NREI have been speaking with the top leaders of the three large oil companies, right? IOC, HP, and Bharat Petroleum. And they have all now, as of yesterday, the mandate had not reached them, but we spoke early in the morning. And post that, I think this information was released. So right now, the supply is dwindling. There is very limited supply. In most cases, whatever was left over with the vendors, the distribution vendors, that's what's remaining. In my system, if I were to tell you, and we're in many cities around the country, we're not been having access to any fresh supplies at the moment. Whatever we have is stock that we already had, and that probably will not last the weekend. So yes, there is a definite dearth of availability currently. That being said, with the new mandate being given out to ensure that commercial LPG is made available, and our internal talks with the three largest LPG producers in the country,
sure.
It appears that production will also be ramped up. And the moment the clarity is given from them, they had been asked to prioritize domestic over commercial. That makes a lot of sense. These are war times, and we have to ensure that people's houses are fed. But at the same time,
no argument there, Zorawar. No argument there. I'm just trying to figure out what happens in the next few days now. If it takes a while to be able to make LPG available to your industry, are you going to see significant closures over the next 24 to 48 hours? You are an association that represents, 500,000 restaurants? Are we going to see a significant number of them shut down over the next 2 days?
Unfortunately, that could be the case, and you are already seeing people to do two things. One is either move to a very restricted menu using equipment that they can serve food on, and the second is absolute closure. And yes, that's what's happening. People are now moving to a lot of alternative forms of cooking. We at the NREI have issued an advisory that clearly mentions how they can use other forms and actually continue their business, at least not shut it down completely. But yes, there have already been shutdowns, and we expect more over this weekend. And yes, this number could burgeon even further.
Zorawar, you talked about how commercial...
I just wanted to ask a quick follow-up question. Yeah, just a quick follow-up question on when, Zorawar says that several restaurants have been, sort of advised to move to other forms of cooking. How easy or difficult is that to suddenly move from gas-powered ovens or gas-powered stoves to move to electric stoves? Even that retrofitting, if it can be done for the large restaurants, would take days, right?
Yes, absolutely. It cannot happen overnight. Equipment has to be ordered. It has to be plugged in. You may not have that kind of electrical load to put, because these were designed with gas in mind. So now you suddenly have to have enough electrical load in your kitchens and in your cloud kitchens. Cloud kitchens are usually very small, about 300 to 400 square feet. And you might not even have the electrical load to be able to, power these equipment. So it's not going to happen overnight. I'm just saying that if this goes on and if the supply lasts longer, there has to be some action taken by the industry, and the NREI has then, as a result, issued this waiver. But like I said, I'm hopeful we don't come to that, because India only produces about 40% of its own LPG, which I believe the oil companies have been asked to ramp up to by a few percentage points. So that might go up to 55% of original requirements, but that still means you're at half. So yeah, imports will be required, and there is no immediate, there's no band-aid solution here. This will be a slightly longer process, but yes, there will be some damage, some collateral damage, some I hope no livelihood loss, because this is temporary, it's a blip and does not last long. So that's our hope, and I think the action that's being taken could be resulting in ensuring that this large industry that's very important, feeds the nation, continues to survive, like the kind of support we got in the COVID.
Zorawar, you talked about how commercial gas supplies are on the way, but they come at a higher price tag. Are restaurants willing to absorb the cost, or will that cost eventually go to the consumers?
Well, in the short term, they don't go to the consumers. They're absorbed by the people serving the food. I'm not aware of any increase in prices at the moment, so I don't have any information directly related to that. Commercial cylinders were always more expensive to begin with, right? Because it's for a business. Domestic cylinders, which are smaller in size, are significantly cheaper. And the larger ones that are the commercial ones were always more expensive. So I'm not sure if there's going to be an increase in price, but naturally, if you're talking about people hoarding it and then, individual vendors supplying it to restaurants and hotels at an increased cost, that happening, yes, that could be happening. But I'm not sure that the official supply of commercial LPG will be at a higher cost. I'm not aware of that.
It shows the fragility of the supply chain right there, Zorawar. I'm just wondering whether restaurants, can take measures to ensure that they're in a better position the next time this happens.
Well, we've obviously learned, right? We learned a lot from the COVID. I didn't have a delivery business when the COVID started, and now it's one of the largest parts of my business. So we learned. We're eternal optimists. That's what the restaurant industry is, and we're hopeful that we're going to learn from this. We will have to rely on alternative forms so that if any form of we're heavily dependent on LPG. 75% of all restaurants and kitchens produced 90% of their food on LPG. I think that dependence has to be rationalized and mitigated. We should look at other forms. There's another big challenge. Coal is not allowed in many parts of the country. Coal was fueling the tandoors. You mentioned the roti and the puri in the beginning. Not the puri, but the roti definitely is made in coal tandoors, which was banned because of pollution reasons in Delhi and Mumbai. And as a result, a small dhaba person with a small little tandoor that is serving maybe two dishes and chapatis or rotis with his food is not able to even serve that, because of his lack of his gas connection. We'll have to rely on other forms of cooking. We'll have to come up with perhaps more percentage of our system being reliant on piped natural gas rather than the cylinders, which we're currently reliant on, 75% of us. And yes, this is going to be a learning experience, and I'm hoping that, we're definitely going to come up with a directive and an advisory based on the learnings of this particular episode, and pass that on to the entire industry at large, so that we face the brunt of a situation like this much less next time around.
Zorawar, I know that Haslinda mentioned to you about rising prices. Gas prices are up across the world. Eventually, that's going to feed into your costs as well. Plus the disruption of these last few days. Even if you curtail menus, you are going to lose some customers. We're going to see costs across the supply chain go up. So talk to us about how you see that being passed on to customers, because there is a broader economic impact of this on the economy in terms of inflation. And the second thing I want to talk to you about is, if you do see disruptions between even emergency supplies coming your way, are you fearful of labor returning back to their homes in smaller towns and villages, because the restaurant industry does depend a lot on migrant labor?
Yeah, we've seen this before, right, Menika? We saw this during the COVID in 2020 and the second phase in 2021. Yes, so if this lasts long, then naturally, if the input costs go up, say for the next 6 months, you're going to have to see menu price revisions, right? Because remember, our industry runs on thin margins. It's not like we have crazy margins. We have limited margins, and we have to play within those margins. And anyway, there are major constraints as a result of this war. Not just the cost of LPG, but the cost of common goods could also go up if crude gets affected. Right now, it appears that in India, we don't have those limitations. But if that happens, then obviously the cost of even basic fruits and vegetables would go up. Import of food would definitely be going up. So a lot of our restaurants rely on imported items, such as cheeses, that will perhaps become more expensive. If this goes on for a longer time, then menu revisions will happen, and the cost of ordering in or dining out could potentially be impacted, but that all remains to be seen. Last time in the COVID, this did not happen because we were able to somehow mitigate. There was many other people supporting us, landlords not charging rent, etc., etc. If the entire ecosystem works together, then you may not have the passing on of the increased cost to the consumer. But obviously, if we're left out in the lurch and there's no support from other other people of the ecosystem, then you could see eventually this carries on that the price of the things will go up because costs of not just LPG. I think if this goes on for a long time, the cost of even fruits and vegetables and basic items could go up.
Okay, all right. Zorawar, one final question from me, and that is that, this is an industry, like you said, has faced significant challenges over the last 5 years. Things like COVID, things like, quick commerce or 10-minute delivery and cloud kitchens, and now this. What do you see being the broader impacts on entrepreneurs like you who have large restaurant chains across the country? What do you see this industry emerging as at the end of all of this?
Stronger than ever. That's what happened during the COVID. I think it shows the resilience that the industry has. Like I told you, if you're in the restaurant business, you better be an eternal optimist. So that's what we are. And we're very hopeful for the future of this country. I think the current economic and consumption trends of this country bode to the fact that all the companies that are serving food of high quality around the country are only going to burgeon from here. So we're very hopeful about the future for sure. If you ask me what's going to happen a month from now, I think there might still be remnants of this crisis remaining. I'm hoping that the LPG issue will be resolved. But overall, the industry has just started out. We're at the nascency phase still. If you compare us with the Chinese or the American markets or even the other Southeast Asian markets, we're still a small fraction of what those markets are. Although the consumption at the urban level is going to burgeon to an incredible amount by 2030. I think we're going to have the largest urban domestic consumption market in the world by 2030 or 2032 is what I've read. So yes, the long-term prognosis is brilliant. We came out not unscathed. We came out hurt and damaged and bruised after the COVID, and we're expecting to come out hopefully much stronger than that this time around because I hope that this can be resolved sooner. But yes, overall, deeply optimistic about the future of the industry, and we hope that this crisis is resolved soon.
Zorawar, thank you. Zorawar Kalra, founder and MD at Massive Restaurants and Vice President at National Restaurant Association of India, and of course our very own Menaka Doshi. Now, something to alert you to, the yen has fallen to its weakest level since July 2024 as a deepening war in the Middle East pushes up oil prices. The Japanese currency inched a tenth of 1% lower to 159.46 against a greenback as Brent oil traded near $100 a barrel. Japanese Finance Minister Satsuki Katayama told reporters that financial authorities are staying in closer contact with their U.S. counterparts than usual and that she would refrain from commenting on the topic of currency intervention. Still to come, it's not just restaurants that could be bit by the war in the Middle East. Chip makers might also be in the crosshairs amid supply disruption concerns. That is next. This is Bloomberg. Welcome back. You're watching Insight. We're watching chip-linked stocks in Asia as tensions over possible supply chain disruptions hit sentiment. For more, let's bring in our Asia Tech correspondent, Annabelle Drulis in Hong Kong. And Belle, this has to do with helium in particular and the Iran war. What is that relationship?
Yeah, this is quite a significant one to unpack essentially, but what you need to understand is that helium is an essential ingredient in the chip making process. So there's a lot of different technical details to this, but what is most important is that it has exceptional cooling capabilities, helium. So it's not built into the silicon wafer itself, but it is essential for cooling it down. And so that's really important during the etching process in particular, especially as chips become smaller and smaller. So the link of helium to the Iran war essentially is that there was a drone strike by Iran forces on the Ras Laffan LNG plant in Qatar in early March, and that forced production offline. This is the world's largest LNG facility, and then the relationship here is that helium isn't mined directly, it's actually a byproduct or extracted during the refining of LNG. So knocking out this output, you can see here how much Qatar makes up for global output. I mean, behind the US, but importantly where the refining for helium happens is typically in Qatar and Russia. They're the major suppliers into the semiconductor industry. So this shuttering of the plants could end up having ramifications or knock-on effects for the chip makers. just because there's no viable substitute for helium in the semiconductor process, and there's also as well no other sources that can immediately replace that output from Qatar.
So a hit to chip makers. What's been the response so far?
Yeah, a possible hit to chip makers. I think so far what we're hearing from the likes of SK Hynix and TSMC is that they can handle the disruption. According to our geoeconomics team, for instance, Korea has a multi-month supply that's already been secured. But the question is really, if disruptions do persist beyond several weeks, then it could force the chip makers to further deprioritize lower margin product lines. So you're already seeing this happening, just given the amount of interest in HBM. And for players like SK Hynix and Samsung, they've continued to prioritize HBM at the expense of other types of memory that's used for things like smartphones and PCs, for instance. That could end up being exacerbated if you do have that shortage of helium. But as I said, it does depend on how long this lasts and whether we actually end up seeing it constraining actual production.
And Bell, in other chip news, Chinese chip designer Cambricon posted its first ever annual profit. What else can you tell us?
Yeah, this is a significant milestone for the company. This is one of the better known chip designers in China. It's really making, or on a mission rather, to not only capture market share from Nvidia. I mean, it's been forced out of the country. We'll see if it comes back at all after this Trump-Xi meeting in early April. But from Nvidia, that loss, plus also importantly Huawei domestically. So they've just reported net income of $306 million. That's 2.1 billion yuan. It was just shy of analyst estimates, but you compare that to where we were in 2024, which was a 452 million yuan loss. So, of course, managing to make inroads there. So full year revenue coming in at 6.5 billion yuan. That was up from 1.2 billion yuan. But a company, as well, as I said, founded back in 2016, trying to make these inroads and really crucial within China's overall efforts for self-reliancy and self-sufficiency in AI.
Annabelle Drewlers, thank you so much for that. And that is it for Insight this week. Plenty more ahead, including next week's shows, of course. Keep it here with us. This is Bloomberg.